Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
This episode is sponsored by our friends at YCharts. If you're still piercing together data from spreadsheets and Fed websites, it's time for an upgrade. YCharts just rolled out a powerful new yield curve tool, and it's built for serious macro analysis. You can visualize real-time treasury yields from 1 week to 30-year, overlay historical curves, track key spreads, and even spot intraday shifts, all in one clean, interactive view. This is the kind of tool that helps you move beyond gut feel and into data-backed macro strategy, whether you're forecasting recession risk, building fixed income strategies, or you just need to explain curve dynamics to clients. This tool delivers clarity fast. No more wrangling with Excel or hopping between data sources. YCharts brings everything into one streamlined view, making it easy to export visuals directly into your reports or client presentations. Click on the link in the show notes to level up your macro outlook with a new yield curve tool and get 20% off your initial YCharts professional subscription when you start your free YCharts trial and tell them that Meb sent you for new customers only. You can go to the website go.ycharts.com/Meb-Faber. Welcome back, everybody. It's summertime, so we got a special show for you today. Our guest is Cole Wilcox. Cole is the Chief Investment Officer of Longboard Asset Management, boutique asset manager specializing in alternative investing strategies. Cole, welcome to the show.
Hey, Meb. Nice to see you.
Listeners who aren't watching this on YouTube, I got a new hat that just showed up to add to the background. It says Longboard Asset Management. Very, very nice design. Do you design this one?
We designed it straight from the Branded Bills. Shout out to the guys at Branded Bills.
All right. They do good work. Well, look, we're going to talk about a familiar topic in an unfamiliar way today, and that topic being trend. But trend applied somewhat differently than the way I think the majority of the world thinks about it. What's your trend inoculation? Is this something that came to you early in life, late in life? What was your exposure? Do you remember?
I remember because it was a byproduct of just getting kind of wrecked in the early part of my career. So I started in 1997. So I saw the 1998 financial crisis and then an internet boom after that. And then the tech wreck of 00 to 02. So in that first 5 or 6 years, you saw a lot of money made and a lot of money lost, and the importance of risk management. And that's where I got introduced to trend following kind of strategies. And there's got to be a better way than just this boom bust cycle. So I'm a little bit of a depression baby in that case from my early career development.
I try to be not too dismissive of the youngins today when I see them trading Dogecoin or futures on the next election or whatever, 0-day options, triple leverage stocks. Because certainly back then with CMGI and Lucent and Gene Labs and any other late 90s stock that gives all of us PTSD, different time, but not too dissimilar. Tell me a little bit about how you think about trend and what does that mean to you? Like you ask any one person when you're talking about trend, it could mean 1,000 different things. Someone may say super long-term. Some may say short-term, some may say breakout, some may say moving average trend. How do you think about it in general? Any thoughts?
I think trend in general is just any strategy where you are not fighting the market. So you're kind of going with the flow, positioning yourself to be directionally long or short if it's a long-short strategy in the general prevailing trend of the market as a whole. But more importantly, that you have a disciplined stop loss or a way to get out of that or admit that you're wrong and fold on the trade. You have to be a very good loser to be successful as a trend follower. So I think any strategy where you have an entry and an exit that's kind of rules-based and can manage risk, and you're seeking to kind of generate outsized returns on the upside relative to the risk that you take, would be my definition of trend and a trend strategy. So there's a lot of ways to do that, but in the big picture, I think that's kind of what it is.
And so much of it relies on this concept of the big winners. And so many investors, what they seek is certainty and a high batting average, right? Most investors, you go on Twitter, they're killing it, all their trades are great. And then you talk to your average trend follower, so listeners in your head, the average trend following traditional algorithm has a pretty low batting average on average, but bigger winners. Is that true? Do you agree with that statement? Is that kind of how you think about this world?
I don't think that's unique just to trend following. It's a frequency versus magnitude. I think the best investors are not particularly great at having a high batting average. I saw an interview with Ken Griffin from Citadel, and he was describing the historical statistics of his best traders and portfolio managers. And I think the historical win rate was like 54%. So his best desks are only having a 54% win rate. It's the issue of how much are you making on your winners relative to the losers. And there's a huge amount of asymmetry. I think when you see it, when you look at trend following or you look at a Warren Buffett's portfolio in Berkshire, it's a concentration of a handful of their best ideas that have generated 90% of the results. So that power law kind of concept, I think, is just a fundamental law of capitalism.
Power laws rule everything around us, it feels like. In the stock world, I feel like this really hit the mainstream with the Bessenbinder study, which, and I used to give, not doing this to Hank, this goes back way, way earlier. We're going to touch on this in a minute. But the statistic really came from you guys on, stocks, how many outperform the index, how many underperform. Back in the day, does trend following work on stocks originally published?
20 years ago. So 2005,
My God, man, you're getting old. 20 years ago?
I'm going to be 48 this year. So it's a while.
In my head, I'm like 2005. That was only 5 years ago. What are you talking about? So we're going to spend a lot of time on this paper, listeners. I put this in the category of kind of Hall of Fame papers. And Colby, I think we need a section on the Idea Farm that has like the top 50 papers, but this would definitely be on there. We featured this heavily in my first book, if I recall.
I think it was the Ivy portfolio that you put this stuff in, and the capitalism distribution paper that we did also.
Capitalism distribution. Yes, that's right. Tell us about the original paper, and then you guys have just done an update called Does Trend Following Still Work on Stocks? Give us the overview.
Yeah, so we did two papers kind of in the 2005 time. They were related to each other. One was the trend following on stocks. Typically, trend following has been a futures-based strategy, and nobody had done any work on, does this work on individual stocks and as a way to kind of improve the performance of investing in the stock market? So we did that work. And then that led to a second paper called the Capitalism Distribution, which showed the kind of non-normal distribution of stock performance, where you have this power law of extreme winners that dominated 100% of the results. And then everything else was just like most stocks were just complete garbage and added no value or negative value. And I think that's the work that you're referring to at the Bessenbinder. When he wrote his famous paper now, a few years ago, he was kind enough to cite us as like the inspiration for it in the paper, which we appreciate. And he obviously did a very outstanding and level of work on the depth that he went into taking that idea and running with it. So the original paper that we're talking about, the trend following on stocks, though, was just an empirical evidence of, hey, does this mechanics of trend following on individual stocks, there had been no research done here. Does it work, right? Is it effective? Is it not effective? And that's kind of what that original paper was about, and try to carve out a different kind of niche and, something that was a different way of applying, an innovative way of applying trend following that hadn't been done before.
And I feel like if you are honest and open to ideas, the bogleheads out there, you look at the market cap index. And so one way to kind of not guarantee, but ensure you own some of the winners and you end up owning all the losers too. But the algorithm for position sizing on market cap index is essentially a trend style of algorithm, whether people want to admit it or not. It's a pretty basic and doesn't do a whole lot. But at its core, market cap indexing, in my opinion, is kind of a trend following index. Agree, disagree?
No, I completely agree with that market cap indexes are trend following. I would just call them very slow moving trend following strategies. So you're slow to increase exposure, you're slow to decrease exposure. But over time, it's going to evolve. You're going to own more of what's been working, you're going to own less of what hasn't been working. And it's going to naturally kind of follow that process. So I would completely agree that cap weighting is a naive, slow moving form of trend following.
Yeah, the problem with trend, if you have a giant, huge company, so let's call it NVIDIA or Amazon or something, a more active position sizing and trading algorithm, a true trend algorithm, if that company rolls over and it's a multi-trillion-dollar company, it's going to get out at some point. Maybe it's down 20, down 25%, whatever it may be. But for the market cap index, it doesn't. It just goes eventually to zero. And so the stop loss is at zero, or whenever it gets kicked out of the index, it's not at a off the highs sort of algo.
Yes. I mean, the trend following component of a market cap weighted index is going to be very good at ensuring you have all the big winners, in the portfolio, capturing all the big trends. It's also going to capture all of the asset depressions that happen as well, because it's not trying to be a low beta or low correlation diversification alternative strategy. It's just applying trend following to give you optimal odds that you're going to do well capturing equity market beta.
Not to give away the conclusion, listeners, but the original question was, does trend following work on stocks? I don't think we'd be here talking about it if the answer was no. With a 20-year retrospective, maybe talk a little bit about the initial conclusions of the first paper. Like when you say trend following on stocks, what does that mean? Just kind of walk through at a very high level how you went about even testing that hypothesis and what you think. And, in the modern paper, we'll get into as well.
Well, the first thing, we just wanted to establish kind of a universal, something that everybody could agree on, that this was a way of determining if something was in an uptrend. There's obviously thousands of different indicators and a way that you could calculate trend. We just chose to do something very simple, which was if a stock was at an all-time high, it clearly is in an uptrend. Every short-term, long-term, intermediate-term indicator is going to say it's up. So that was what we established as the rule for entry, was every security that ever went to a new all-time high would get a trigger to come into the portfolio. And then you have to pair that with some form of exit criteria. We chose a average true range indicator, which is a pretty standard industry kind of practice, that is a volatility derived stop loss that just kind of trails behind every position. And we tested different levels. So some of them would have been short-term, intermediate term, or long-term in nature, to kind of look at which ones were effective and not effective. But it's just a very simple entry, exit, kind of basic trend following process to do this test to determine, was it effective or not effective at capturing moves, and could you produce a result that was better than equity indexes. I say that better in quotation marks because the definition of better doesn't make a lot more money. It's more, can you generate the same or better returns than equity beta, but do it with substantially less risk, less drawdown, less volatility, lower degrees of correlation? That tends to be where you find trend following strategies are adding value the most, and would be defined as better on a risk adjusted basis. Not that you're going to get twice the level of the equity beta stock market return. It doesn't do that.
Yeah, we needed this in 2000, 2003. I imagine would be a great period for this type of idea. So, okay, all-time high, that's like as generic and all-encompassing as a trend following indicator could get. One of the cool things you guys have in the paper is you show a handful of examples of things like Bear Stearns or Lehman Brothers and Sun Micro, Eastman Kodak. I mean, come on, this is hitting every generation, all these names. And so thinking about how long you would be long in some of these, McDonald's, on and on. And it kind of visualizes, okay, the nice part is that there's an exit at some point. This isn't like a top picker type of thing, but maybe so walk through kind of how you went about testing this at the portfolio level, and then kind of what were the results? What did it say?
I mean, testing at the portfolio level was just getting all of the data, right? So the biggest part of the original challenge for us was just capturing all of the data, adjusting it for corporate actions, and just making sure that what you were working with was a clean data set. And then obviously the rules by design were designed to be kind of simple. So it's just a simple backtesting kind of software that was set up in order to accurately measure point in time, which stocks should be in the portfolio, which should be out. We obviously eliminated certain stocks from, if they weren't liquid enough or other kinds of things that would have made the research kind of not viable in the real world, right? There were some filters where we wanted this to be a real strategy, not just a paper architect kind of thing. And ultimately, the results of the paper were it tested, tens of thousands of trades in the original paper with data. I don't remember the exact date, but the data went back, but certainly into like the 80s, 1980s. And there was a high degree of efficacy. Your winners are bigger than your losers. It did a very good job of eliminating the disastrous investments or the poor performers out of the portfolio. You had a portfolio that was left with more concentration in whatever the big trends were. It successfully navigated and evolved through the different economic cycles and cycles that went on over decades to make sure that you were doing that. And in the end, it produced a portfolio result that kept pace or made more money than equity, like a total equity market, and did it with a lot less risk. The drawdowns were substantially lower, the volatility was lower, the beta was lower, the correlation was lower. So we came to the conclusion that, hey, this was a trend following applied to individual stocks could be used successfully to enhance the risk-adjusted returns of equity investments and to do something that would be a great diversifier in an investor's portfolio.
Most investors, when you think about trend, there's one big consideration when you're managing it is that, all right, am I doing this long flat or long only, or am I doing this long short? How did you guys approach it in the study?
So we looked at it a couple different ways. If you do a strategy that's long only, then obviously, and when I say long only, you're just always 100% invested and you're only doing trend following to like pick the winners and just that's it. You're just you versus index, 100% invested at all times, the same rate. That portfolio is going to have a very high correlation to equity beta. It's going to have a similar beta, to it. What we chose was a long flat strategy. So you has two asset classes. You either own an allocation to individual stocks, a portfolio of individual stocks, or you own treasury bills, or you own a combination of the two, depending upon where you're at in the market cycle as a whole. The benefit of owning treasury bills in a market crisis is that they are the most reliable zero correlation kind of strategy. And then the benefit of owning trending stocks during every other good non-crisis market environment is that stocks are the best performing asset class that you could have been in historically. So the combination of this long flat trend following exposure gives you something that generated excellent returns and also had a meaningfully low to moderate correlation. So it became a real diversifier in a portfolio versus trend following that was only applied in a long only way would not add any real diversification. Might improve performance, but it wouldn't add low correlation diversification benefit, especially during like a market crisis. It wasn't going to like reduce your drawdown during that time. So we wanted an alternative strategy that really could be used as that in your third leg of your portfolio to really help you stabilize the portfolio, navigate market crises, those kinds of things. So we chose a long flat approach.
So you guys actually been running a mutual fund, Long X, great ticker. Is it a decade? Are you guys into the double digits now?
We are into the double digits as of, I think, March of this year. I saw a stat that you did a while back that was like a post around the average life cycle of a mutual fund and how the vast, I think it was like huge amount of them just failed or went out of business or merged away before their seventh year. Half of them.
Half go away, listeners, which is such a crazy statistic. We have a soft spot in our heart for strategies that are different, weird, and wonky. We try to claim that we only launch funds that don't exist. Are there any other, like this must be a small group on the trend following stocks only crowd. I don't know of any other public funds that do it. I mean, some do momentum maybe, but not a traditional trend type of idea.
So there's a lot of systematic trend funds out there, obviously, and there's a category for it. But when you break down what they do, they're applying systematic trend to multi-asset, long, short, commodities, currencies, fixed income, et cetera. We're unique in that is our style of systematic trends. So same discipline, but to my knowledge, we're the only fund and firm that is doing that exclusively on individual stocks in a long flat kind of way that we are. So
tell me a little bit generally, like the strategy for listeners. We've had a market environment since 2009, really, that's been generally an up market. On occasion, it'll have these kind of 20 percenters dip and rip, buy the Dow, buy the dip, excuse me, don't buy the Dow. No one talks about Dow anymore. This type of strategy, how do you think about the various environments this would do best? This would do worst? Is it pretty similar to like a normal trend strategy, or has it got some quirks to it?
it does worse and best, and it has different worst best periods relative to traditional multi-asset portfolio. So where it does worst in an absolute sense is in a full-on market crisis relative to the historical performance of multi-asset trend. I mean, one of the things that the managed futures category or multi-asset hangs its hat on is that historically, at least, it is done very well at producing negative correlation or positive returns during like the largest moments of crisis.
That's because it's got the ability to go long stuff like bonds, gold, yen, who knows what. And also it has the ability to short some of the actual indices. Yeah.
Yeah. So if you get market trends that line up that way and there's enough time to get into those positions and then there's a follow through in those directions, then they've performed favorably well during that period of time and have many times produced positive rates of return. So that's probably the biggest selling point of multi-asset systematic trend is these positive returns during these huge crises and the portfolio benefits to diversification of that. The reciprocal of that, though, is that managed futures and systematic trend multi-asset can be very frustrating for individual investors or any investors really to hold on to, because it can just go through years of underperformance and just frustrating whipsaws and just something or like, why do I own this thing in my portfolio and I don't like it, and suffer a lot of relative performance during bull markets of equity markets.
Also in years like 2025, this is a year that traditional managed futures in general has done quite poorly. SocGen Trendex, we actually did a fun study internally this past week that I mentioned on Twitter. And I said, if you're trying to replicate the managed futures industry, the SocGen Trendex, which tends to be the kind of big index. I was laughing because someone on Twitter was also like, this hasn't been around that long. I'm like, first of all, it's been around since 2000, but also there's been trend indexes like Barclays BTOP 50 and Mount Lucas Index, which go back to the 1980s. But basically, there often is pretty wide dispersion in the managed futures industry. I mean, they generally move together, but based on number of markets you trade, long, short, and specifics on the algorithms, you end up with some different performance. But the funny thing is, if you just buy all of them, and I just use the ETFs for this, you end up pretty close to the SocGen Trend Index, listeners. So it's kind of interesting. It averages out to get a handful of them, but stinking it up on average in 2025 for sure.
Yeah. And so when I refer to any of these performance cycles, I'm always talking about the SG Trend Index. I think that's probably the best benchmark proxy that's out there for what should you expect from this asset class if you have a reasonably diversified group of managers or strategies that are helping you gain exposure to it. But if you diversify across the 10 or 20 largest, those are the results. And the results are, you can have years of drawdowns, you can have poor performance for long periods of time. They tend to do very well in short bursts. So from, COVID period for the, 2020, 2021, 2022, you probably really love those strategies in your portfolio. They did very well. But if you looked at the performance for the 5 to 7 years prior to that, you were like, I'm really frustrated with this stuff. And I don't enjoy this investor experience kind of at all while I was waiting around for the next crisis to happen. I mean, the reality is, it's important to have a diversified portfolio and it's important to have exposure that can survive during a market crisis, but that comes once a decade. So what are you doing the other 90% of the time is the question. And that's where the trend following on stocks actually is a better performer, does a much better job of, without losing the risk management and without losing the hedge of if things really go bad and there's a full-on market crisis, you're not going to eat that drawdown and you're not going to get hammered. It keeps up and does very well in bull market, kind of environments. So your average investor return for a 1 year or 3 year or 5 year or 10-year rolling period relative to a diversified trend following multi-asset portfolio is just a lot higher. It has made a lot higher rates of return and it has been a lot more consistent in its rate of return. while still having downside protection and low drawdowns. What you give up is the ultra low correlation that the industry of managed futures loves to promote, that it's negatively correlated or zero correlation. So you accept a moderate correlation, still solid diversification benefit for much higher rates of return, a lot higher level of consistency of results. So the trend following on stocks is like a 0.29 correlation to multi-asset trend. So while they run the same discipline, they're very uncorrelated to each other. So they can be used together or they can be used independent from one another, kind of in an A/B foot race of which one do you like.
It's like the old Dalio comment. He's got a lot of comments, but one of them was basically like the holy grail markets is you want to come up with about a dozen non-correlated different streams. And I think most people, when they hear that, they're like, oh, great. Large cap growth, large cap value, mid cap growth, mid cap value. And they're like, no, that's not how this works. It's like not just assets, but styles within those, but also geography and approaches. So something like a trend. So for the people listening to this, I saw a statistic and this sounds fantastical, unbelievable. So you'll have to quote me on it. How many trades on this type of strategy tend to be profitable? Is there a ballpark guess, number, estimate you guys have come up with?
I have that number. It's the profitable is less than 50. So I think we lose on 56% of the trades. You have to be good at becoming a good loser if you're going to be a trend follower.
Yeah, I think on the practical nature, we always talk to advisors, we talk to investors over the years. And one of the biggest takeaways about trend is it's not totally unworkable to implement on your own, but it's got some challenges to be able to be a totally logical, unemotional robot that's just going to take every trade after 2, 3, 4, 5 losing trades in a row of whatever it may be is tough. And most aren't cut out for that. Talk to me about how you guys approach the portfolios as a whole. So what's sort of the range of number of stocks you typically own and what's kind of the max min? Is there sort of a ballpark on this strategy that is a sweet spot?
It's not a sweet spot. I mean, we have a lot of stocks and we err on the side of maximum diversification in our universe set the same way that a market index does, because we know that a small minority of stocks are going to end up generating all of the return. So if you have a screen that somehow misses even a handful of those best performers, it really kills your rate of return. So not making unforced errors of missing out on whatever those future winners are is critically important. So one of the best ways to do that is to have maximum scope coverage on every stock that's really out there. So we cover the whole kind of Russell 2500 in terms of the positions that we're looking at and the potential to capture trends. And that tends to be that we own on average maybe 20% of that investable universe, maybe 400 to 800 stocks. It kind of depends on the total market breadth and what's going on. But I would say in that range of 20 to 25% of the market is what these trend strategy filters out and that we own. So we end up not owning approximately 75% of our tradable universe, and owning about 25% becomes like the remainder best performing positions that get filtered in.
Do you end up putting any sort of sector industry caps on this? And then do the number of names ever go to zero? I mean, theoretically and practically speaking, there's both sides of this.
We don't have a cap on sectors. In theory, you could just have everything kind of in one sector. In reality, that doesn't happen, but it's theoretically possible that one sector could dominate the portfolio. And that's a feature. It's by design. You need to make active bets. I mean, our strategy is attempting to do something different than a market index. We're not trying to replicate market indexes. We're trying to do something very different. For better or worse, your active bet will either do well or do poorly, but you need to do something different to get different than average results.
Let me hammer that home to the listeners, because the amount of conversations I've had in the past 15, 20 years where someone was like, oh, well, why is this portfolio underperforming? Why is it outperforming? Why do you have this overexposure, underexposure? Ooh, that's a lot. And I'm like, literally, the entire point is you have to be concentrated and different. And the vast majority of the investing industry ends up just doing closet indexing, which is the worst outcome, right? You can go out and get market cap for 5 basis points. The worst outcome is you think you're getting concentrated, weird, and different and paying for it, but getting market cap index, right? Which is what like so many of the big shops do. And we wrote a piece on this, and I love Vanguard listeners, but it was called Nobody Gets Fired for Buying Vanguard, but maybe they should be. And it was talking about a $80 billion fund. I was like, look, even if this thing wanted to concentrate, it couldn't. It's too big. So I think that's a really important point that you made, which is if you're going to be active, like be active. Don't just say you are and then charge a bunch of money for it and don't do anything different. All right, sorry, end of rant, end of soapbox.
It's the benchmarking thing. Also, it's important like to have an appropriate for any manager, any strategy. Like we charge fees. So we need to be able to justify that the fees that we're charging are worth it. You certainly shouldn't be charging or hiring a manager or paying fees to a manager of any kind if they can't demonstrate that they're adding real value to what's going on. So taking a portfolio and having equity beta, disguising it as alpha and charging you fees for it, like that is not something anybody should be doing as an investor. Well, we get beat up a lot because people immediately would look at our fund and then compare it to the S&P 500 and say, oh, you've underperformed the S&P 500 over the last 10 years. And I go, well, yeah, that's true on the return standpoint. But I will also say, I don't own S&P 500 stocks. It's not the appropriate benchmark, for us. We are not a cap-weighted index. And by having a large universe, we tend to have more of a small to mid-cap bias or tilt in our portfolio because of this large universe. Most of those companies in the Russell 2500 are smaller mid-cap companies. So while we own some large caps and large cap trends, they make up a minority of the overall exposure. So you need to benchmark and kind of look at the performance relative to our universe. So say the equal weight Russell 3000 would be the appropriate benchmark for us. And then when you compare that to us, you're like, oh, well, you've actually outperformed that on a nominal return. And you've had far less risk, low correlation, low drawdown, whatever. It's like a completely night and day difference. So it's important to make accurate comparisons and have the right benchmark when you're kind of determining is somebody worth paying fees for.
You guys have done a good job historically navigating these crazy markets. What is a year like 2025 like for y'all? Because, as mentioned earlier, a traditional trend strategy is probably getting chop suey at this point. But for y'all, focusing on something specific like just US stocks, how does like a real-time sort of strategy walkthrough on something like that?
So, we came into the year, obviously last year was a good year. It's a bull market, markets rally after the election. And then, internally started to break down a little bit. You started to pick up on some trend reversals and a reduction of positions kind of coming out of the portfolio slowly, maybe starting in December or January. And then it starts to pick up as we get closer into the tariff kind of discounting mechanism of things that are happening and then the news. So through that whole cycle, we were reducing risk and kind of went from being maybe close to fully invested, maybe 90% long equities, 10% T-bills, now to a 50% T-bills, 50% equity type position. So it's a normal market correction in our experience kind of historically, but it's not like COVID levels or global financial crisis type levels. It's just a little bit of a pullback that's caused us to go a little risk off. If the markets were to sell off further from here, then you would see a lot more risk be shed from the portfolio as like if the market were to take out the lows that we just recently had, you would see that T-bill exposure go a lot higher and kind of the remaining trends that are the relative strength stocks we still own get purged and go into a more defensive risk-off position.
How often are you guys looking? Is this every month, every day, every quarter?
Every day, recalc the new positions and different market trends that are happening, append the data, run the portfolio, do the rebalances, do the things that we need to do to kind of size things up while still minimizing transaction costs and whatnot in the portfolio. But it's a daily process of evolving what we need to do.
Are there any names you've held for 3, 5, 10 years? Is that possible in this strategy?
So in the historical backtest of the most recent paper that we published that does trend following still work on stocks, backtest went back to 1950, somewhere in the 50s. it drastically increased the data set of the history. I think it did like 60,000 trades over that time frame. Our average hold time on profitable positions or things that we make the most amount of money on is going to be measured in years. This is not it's a long-term kind of approach. Average hold time on the losers, though, is going to be like 6 months. So we have a higher frequency of losers, but they also tend to be held in a very short period of time. And then we have a much smaller amount of winners. Like in the paper, we over that 60,000 back test to the 50s, only 7% of the trades were responsible for 100% of the strategy's total gains. And that 7% is going to be positions that you held on to for a very long time that were kind of like the super trends that did very well, and you made all of this money by just letting them kind of compound over time. And when you eventually did have a trend reversal in it, you held it for a long time, so it's kind of preferential capital gains treatment. So one of the things about this strategy relative to like a futures trend strategy is that it does have a vastly superior tax efficiency to it, because you tend to be harvesting losses every year, and then you're deferring gains on the long-term winner type stuff. And then when you do have those realized gains, you have this whole bucket of other losses that you've been accumulating over time that you can offset it against. So like we've not had a kept gain distribution since inception of the fund, because the natural process of equities versus futures and the selling losses and then holding on to these long-term trends is quite a tax efficient strategy.
Yeah, I remember using your trade length versus returns chart, and it's a scatter plot, listeners, where again, like the nice thing about trend is you're taking all those short-term. I wonder why the direct indexing crowd hasn't really adopted a lot of the kind of trend ideas, but you take a lot of the short-term losers, hold the long-term winners, tends to be much more tax efficient on the direct side. It reminded me of something, and now I'm blanking on what it was. Oh yeah, so I had a buddy runs a research company, and he wanted to test out a thesis, which was he had all these analysts that made discretionary fundamental stock recommendations. And he said, I want to test a very simple idea. Would their portfolios and recommendations be improved by adding a simple stop loss on these stocks over the years? And I forget, 25%, whatever the number was. But basically, on a monthly level, the number's not important, but basically the results were very clear. All these analysts should have had a trend following exit. And the reason is simple. And if you think about it, listeners, it's once you buy something, particularly if you do the fundamental analysis, you become emotionally attached to it. But on top of that, you maybe stop spending all your time looking for evidence to question your thesis and spend all your time looking for confirming evidence of why you're so brilliant and the stock is going to a million, whatever it may be. And so with so many portfolios, by far one of the biggest detractors is the things that go to zero or near zero, 90% loss, where I'll just sell when it gets back to even. I can't believe my neighbor told me to buy that. There's no point in selling it now. You can just go through the whole range of emotions all the way down to zero. And so I think having the exit is important to think about, particularly for the fundamentalists out there who are listening to this, who most of them, it's just the investing strategy is just wing it.
Yeah, I mean, whether you invest in a professionally managed trend following strategy or you apply the philosophy yourself, I mean, there's huge benefits to it. I think it can help by just eliminating the straight up disasters. So that safety net of like, I did this work, I thought it was going to work, but I had a way to get out that kind of forced me out, as being your personal risk manager on something. The other part, though, is the keeping you into a good idea, right? It's far more important that you hold on to these positions that win and work out kind of over time. And if you have a mechanical exit process, then you spend the worst part is you get up on it and you double your money on a stock and then you're like, oh, I'm up, I want to sell it. But really, what if it's that stock that's on its way to being a 20x or 30x return? There are very few of those that happen in life. So it's important that if you were fortunate enough or intelligent enough to buy one of those stocks, that you hold on to it long enough to reap the rewards of all of your work. And trend following is a mechanism that can do that. It can keep you holding on to things and not have you be like, when do I have to get out, or trying to call a top in something.
I mean, this is important too. Like we talk to investors, it's not just important for the losers, right? Like, all right, I got a position, it goes to zero. It's also important that it keeps you invested to the upside. So we often say to people, hey, every 100 bagger or even 10 bagger was once a double. And how many people buy a stock, it doubles. They're like, oh my God, I'm brilliant. I'm selling it. I got to tell all my friends how smart I was. We're going to Cabo. We're going to buy a new car, whatever it may be. But in reality, had you held it, there's so many of these stories in the past. The guy that sold Berkshire in the 70s, and someone who sold Bitcoin for pizza, on and on. The nice thing about the trend following algorithm, whatever one it is it also keeps you invested. If it's going up, it gives you enough wiggle room. And maybe you do something where you're like, look, I don't want to go all in on this trend stuff, but maybe I'll say I'm going to sell half of this if it hits the eject button, but I'm not selling the other half as long as it's above the trend, whatever it may be, listeners. It's useful not just for the downside, but also to keep you invested on the upside, which is where the big money gets made, right? Like the whole point of this podcast is the power law discussion, like the big winners, 7%. That's crazy number to me. But if you exclude the 7%, it's like Buffett's picks too. It's like you take out the top 5 stock picks, he's totally average.
It's definitely a universal thing. But like the trend framework, regardless of how you kind of implement it, can be applied to anything. I mean, you could have known nothing about Bitcoin and been terrified of that as an asset class. But if you just applied a very simple trend following mechanism to it that says, I'm going to buy Bitcoin every time it goes to a new high, a new all-time high, and then I'm going to use a trailing stop behind it. And you did that from the time that you first heard about Bitcoin and applied that through time, you would not have made as much money as just holding Bitcoin without ever making these changes along the way, but you would have done well. And you would have had that sleep at night factor that if Bitcoin did do what the naysayers said that it was going to do, which is go to zero, you wouldn't have ridden that thing all the way down to zero. So you had the optionality of making all of this money in a 20,000% return in something. And all you were risking was the distance between the entry price and your trend following exit. So it constantly provides this system for asymmetric bets. I mean, trend following isn't going to work if the trades that you're taking or the investments that you're making have no asymmetry potential. I think this is probably the biggest thing that, I would give advice to people in thinking about trend following in general, is like the Peter Thiel concept to venture capital investing, was that the power law is real. So when you're evaluating a venture investment, don't invest in something where the potential that you literally think this one investment that's going to be a small portion of my portfolio can return my entire fund. So if it can't be 100 bagger and it doesn't have the potential, then don't ever invest into it, because you need those 100 baggers to like make returns successfully in the venture game. In trend following or investing in general, you need these big outlier events to happen. So if you apply trend following to things that you look at and say, this has a 10 or 20 or 30x return potential, maybe very risky like Bitcoin or something else that terrifies you, but also has the upside, then you don't have to be a predictive genius. You can just, let the process kind of play out in a way that's far less risky than just betting and holding and hoping that it works.
Well, we're recording this on a Bitcoin all-time high day. By the time this publishes, who knows? So we're at 108,000. By the time this publishes, it could be anywhere between 200,000 and 50,000. Certainly has the volatility to go along with it. I think when we did a previous podcast and we were trying to size it appropriately relative to gold, and I think the guest said it was 6 times more volatile than gold. So slightly different volatility sizing. You make a good point. And I think most listeners would assume that the best performing stocks in history came from tech. On a daily basis, it's like, oh, NVIDIA, Apple, Microsoft. But then you look at the Besson Binder study, and it's fascinating. You see a lot of the best performing stocks weren't tech stocks, and some of them boring as hell. And then we had him do a really fun study. Well, I didn't have him. I asked him, and he did it because he's great. But it was basically, what's the best performing stock of all time? Now, this is a little different because it puts a big weight on who's been around the longest. So it's basically like, could you have existed the longest. And the stat, listeners, if you don't remember this, we're talking about a total percentage gain of 265,528,901%. So $1,000 100 years ago would be $2.5 billion today. And we had people guess, and some people said Berkshire, some people said Microsoft. And of course, it was Philip Morris, now known as Altria. But number two was like Vulcan, or like, there was a bunch of, you look at the top 10 and you're like, oh, these are boring companies. This isn't the high flyers anyway. But the point of the trend following is it's agnostic. Like you pick up Costco or you pick up Monster Energy, and those are some of the best performers. And Bespoke Investment Group puts out some of these charts on occasion, as does Charlie Piello on Twitter. We'll try to link them in the show notes, but they'll post some of the best performing stocks the last 30 years. And I think people will be surprised when they review it, because I think they would assume it's all tech, but it's not.
No, it's definitely not all tech, and it's not all tech in the current market environment or the long-term kind of past market environments. There's a lot of different sectors. There's a lot of things that have done well, boring companies, simple businesses, stocks every day that current trends right now. We were talking about, somebody was saying, Chili's restaurant, has made a comeback and the stock's doing real well. Wall Street Journal profiled it. And I was like, oh yeah, we own that. These things that go on to, be big winners, the trend following strategy is always going to own every single one of them. Like everybody, after the fact, there's a narration and there's a story of something that happened. But if you just run a disciplined process, you will assuredly own every single one of those positions, like in your portfolio.
The Chili's, that was like the fancy place to take a date in high school. When you really wanted to impress them, we went to a Chili's not too long ago. And I was like, let's reminisce a little bit. Let's see how bad this is. And it was pretty bad. The food quality, not quite what I remember when I was 16 years old. But that's the fun part about being a quant. There's a lot of the times people will scoff. We'll talk about the portfolio of something we own, and they'll be like, you don't even know what's in your portfolio? And I said, that's a good thing. I said, half the time you look at all these studies, Greenblatt has a great one where, they'd have screeners on their website, but then you could automate it or you could have people go fiddle with it. And they studied it. And sure enough, the fiddlers did worse because they took out stocks like, oh, I can't buy Chili's, like gross. Are you kidding me? And then sure enough, Chili's does great. And we had this recently with my like all-time nemesis of stocks. I looked down in one of our funds and it was like the largest holding. It's still a top 10 holding. I'm not going to even mention it because I loathe this company so much, but that's the beauty of being an agnostic, I guess.
What makes me comfortable with what we do with the trend following on stocks is that, unlike futures, I can anchor off something that I genuinely believe in, which is that the stock market and the success of the US stock market is a byproduct of the success of the American system and capitalism. Competition, the incentives that we have in this country, the governance associated with it, generates these massive wealth outcomes that in the form of stocks that the public can participate in. And so I believe in that system and the potential outcomes of that system. I don't believe in my own personal ability to predict the good outcomes any better than any flip of a coin, but a process of trend following applied to that system that I'm very confident will produce these outsized winners is something that kind of works over time. And so I'm very confident that those outlier movements are going to occur from US stock markets. And therefore, the ability for a stock trend following strategy to make money is permanently embedded into the American stock market over time. I also know that from time to time, there will be some form of economic crisis or depression as part of the American system. It's a feature of kind of the boom bust part of it, risk taking, boom cycles, bust cycles. And you need to manage risk and survive those boom bust cycles so that you can continue to be around to participate from the booms. And so it's a combination of the two that you need to be aggressive, but you also need to be defensive. So I think that the trend following approach to stocks is kind of an aggressively defensive strategy. It does very well at benefiting from the outcome of this American system of capitalism, but at the same time is realistic and pragmatic about the risks associated with that. And it's realistic about the emotional journey too. I think this is a big factor that I see in the marketplace for people. Like stocks have done well A lot of people haven't made the full equity market return due to their own behavior because, we don't really suffer through the big drawdowns, or we get panicked out or read the news, and the news is always trying to give you some reason to tell you that the American system is broken. It's every day right now. As we listen right now, somebody is trying to promote to you about how this is the top and it's all over. But those news stories have been around every decade, going back for 100 years. Trend following is a disciplined approach that can help you ignore all of that, but also simultaneously understanding that those emotions are a real thing. And if you don't have a risk management strategy that you're competent in and comfortable that all your money isn't going to go to zero, if that Armageddon event happens, then you are going to be given an opportunity on a daily basis to make a mistake from a behavioral standpoint to kind of screw up what is otherwise this great byproduct of the American system. That's one of the kind of things about specifically trend following on stocks. I can't tell you the same outcome of corn or soybeans going to produce some big trend up or down from some economic rationale. Maybe it will, maybe it won't. I don't know. But I have extreme confidence that the American stock market is a perpetual system of producing outliers in equities through every new market cycle that comes along. And there's going to be winners, going to be losers. I'm confident in that system. And that's why I think it has worked historically. And I think it will continue to work very well in the future.
Yeah, I mean, there's a unique aspect of equities too, is that you can reinvest those cash flows. Bonds don't have that. Futures, ags, all the other types of assets. Equities are wonderfully unique in that. As you were talking about entrepreneurship and risk taking, there was a stat that I heard. It was from an old survey in the Wall Street Journal. If we can find the link, we'll put it in the show notes. But it was from a podcast with Tom Lee on The Compound and Friends, Josh Brown's podcast. And it was like, it asked people in different countries if it was a good idea or not to start a business. In Japan, it was like 6%. In Europe, it was 12%. In America, it was 94%, which is such an astonishing difference. And if you look at the way that most investors invest in these countries, they don't invest in stocks. Like maybe real estate, it tends to be a very cash and real estate type of investor base. And we saw recently, and hopefully that it makes it in, this Invest America concept from Brad Gerstner, which is seeding every baby born in America with $1,000. The beauty of capitalism is because that compounds, that difference probably only gets wider between the US and the rest of the world. At least now, hopefully, we have everyone involved. As we talk about foreign stocks, Cole, when are we going to get a global fund out of you guys, or ex-US fund, man? Nobody's cared about foreign stocks for 15 years, but they go up too sometimes. Starting to go up this year. We got some places that are finally starting to break out from 5, 10, 20, 30 years of no returns.
For us, it's taken us a long time just to promote this idea of trend on stocks and get people to even listen to us, right? And buy into it and get some traction in something. It's been a long, we introduce a new idea. It takes time to kind of, get some belief in it. So we have that now, starting to get some momentum behind it. We are considering, other products, or because it works just as well in foreign markets as it does in other places. So give us some time, and I think you'll see us do some other stuff in the market.
For the listeners who are like, okay, I'm interested, this type of strategy, how does it fit in? Is it a Lego substitute where you just take out part of your SPY or market cap index and you replace it? Do you consider it almost like an alti bucket? How do you frame the allocation to this type of idea?
Yeah, so our client base that we kind of primarily just dedicate our time is to U.S. financial advisors, fee-based advisors in the U.S. And specifically, in addition to this fund, we're helping them, before we even talk about our product, it's more about how do we help them optimize their alternatives sleeves and what they're doing in the alternative space. I think that's our domain expertise, and that's where we can help kind of optimize what's going on there. Our specific product or fund fits is in that alternatives sleeve as a way to do something that generally is filling a missing hole, either enhancing returns or adding another non-correlated strategy, because we have a correlation like 0.2 average to the top 20 liquid alt mutual funds out there. So in and of itself, it's a diversifier to anybody who has an alt sleeve. It also is number 2 or number 3 in terms of its nominal rate of return amongst everything. So it's a return enhancer in your alt sleeve as well as a diversifier in your alt sleeve. is the way that things are positioned for us. It's not a replacement for your equity beta because it doesn't have a correlation one. It doesn't have beta one. It creates issues if you just are swapping this out in your equity beta world. So it fits in an alt sleeve and can have some different use cases, especially when paired with other systematic trend strategies, because we really enhance the return and the investor experience when you combine us with like multi-asset trend followers.
What's been your most memorable investment?
Well, the one that we're most memorable, most known for would have been like the Tesla, investment. If you ask Grok,
I knew it. Yeah.
who was the first hedge fund analyst people to call Tesla like the next Apple and it was going to go on to do its thing was Longboard and myself. But that's 2013. It was like a $3 billion market cap at the time, right? So I've seen a company go from 3 billion to a trillion over that kind of career period, which has been kind of a wild ride. But there's others, Microsoft was another one that we did a big kind of expose on, and that was prior to it. But I mean, Microsoft was less controversial. I mean, it was at the time because people were like, it's going out of business and whatever. And Steve Ballmer was still the CEO of the company, but you could kind of see where they were going with their cloud platform. That was a big winner.
Listeners who don't know who Steve Ballmer is, he's the Clippers owner now. But no, I remember having these conversations with you about Tesla a decade ago as a Tesla owner now, by the way, great car. But the non-quant in me, the fundamentalist in me, the discretionary, who's probably just a really terrible investor, is a cheap bastard. So I'm actually like on an emotional level prone, like most of us, against wanting to buy all-time highs. We wrote a paper on all-time highs. So I have to rework my brain on these type of things, and most of it, which is make it just be quantitative and systematic, because otherwise, like, I'm attracted to the stuff that's down 90%. That's what tickles my funny bone. And I remember having these conversations with you about Tesla. I was like, Tesla, man, that's gone up so much. And then, of course, many baggers later. You were mentioning one more. Sorry.
The third one probably is Bitcoin, the more controversial investment. It's done obviously very well, but like, who wants to step up and buy Bitcoin at a new all-time high at 107,000? But the math says that's exactly what you should do. Whether you set aside the argument of what it's going to do in the future, just from a trade standpoint, like that's the discipline that you have to have, is to set aside the emotion and be like, this isn't a new high. You have to own it and put it into your portfolio and then ride the trend. Some of the most successful investments along the way are going to be the most controversial type things. Like, they're not going to feel good to own. I've never made a lot of money investing in a stock or in some kind of a trend where it's like, oh yeah, everybody thought that was like the right move to do. They would just give you 1,000 reasons as why it was the dumbest thing. You would find far more people that would tell you today buying Bitcoin at 107,000 at a new high is the dumbest thing you could possibly do. Then you're going to find people that are going to like high-fiving you saying, you're a genius. Like, why don't you do that? The uncomfortable things to do is where the magic is at, in my experience, in investing, to really find stuff that you end up making a lot of money with.
The fun takeaway of our old is investing at all-time high is a good idea. No, it's a great idea paper was that it still had the exit. It had the trailing exit. And so to me, that's key. It's like investing in Bitcoin at 108,000, totally fine. But at some point, you got to have the I was wrong, move on to something else. And I think it's hard for people to give up and move on to the next thing.
Yeah, it's very difficult to give up and move on to the next thing. And that's what I think separates great investors and great traders or whatever. Like, they just don't have a memory about that loss. Like, they're just like, losing money or being wrong about something is part of the process. And there's going to be larger winners than losers. You just have to be very emotionally comfortable with that. And that's who you are, and it's ingrained in it. So that's why you could give people trend following rules and all of the math and all the empirical that it works, but you still have to follow it and kind of do it. And that's where I think that it's hard if you don't have the wiring for it, then it's not something that is a strategy that I would recommend, because it just gives you a lot of negative feedback. And that's not what most people really want or what makes them feel good.
It's much more palatable as a fund, allocating to a fund or a strategy, right? Like, doing it on your own is so damn tough, but having someone do it for you, way better. Come on.
But like, doing what Berkshire Hathaway does is very difficult to do on your own. Most people will not step up, and while they're sitting in cash and the market's down 50% and the government is going out of business, to say, oh, now I'm going to buy stocks and start doing things. Like, normal people just don't behave that way. And that's fine. Like, it's embedded into your DNA to run away from risk or misperceived risk or whatever. So it's important to hire a professional manager who, can do those things on your behalf. Everybody has a skill, like in life. We go watch professional athletes do something that we can't do. There's professional money managers who can do things that you can't do. It's just, physically, mentally, emotionally, they're better wired for those kinds of jobs.
Cole, where do people go? They want to follow what you guys are up to, read your writings, see what's going on with your funds and strategies?
Probably the two biggest places that we're active would be find us on LinkedIn first. We post a lot of content there and engage in conversation. And then the second would be on our website, longboardfunds.com. And they have some interesting research on the site and new research coming kind of in the future, and hopefully a new website coming as well this summer. So all of those places are places to check it out.
Very cool. Cole, thanks so much for joining us today.
Thanks, man. Appreciate it.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.